Hello everyone, my name is Michael Ndoye and I'm majoring in finance.
Hello, my name is Courtney Jones and I'm a major in finance.
Hello, I'm Kim Wood and I'm also majoring in finance.
Hello, my name is Mia Maldonado and I'm majoring in computer information systems and minoring in finance.
My name is Daniel and I am also majoring in finance.
And I'm Nicholas Sailors, majoring in finance.
Today we are excited to present Ember for the 2025 Private Business Valuation Competition by Georgia State University.
Go Panthers!
This slide gives a quick overview of who Ember is, what the company does, and how it operates across Texas. Ember is a Texas-based provider of customized safety solutions for industrial clients. Founded in the late 1970s, the company built its reputation on high-quality, fire-resistant clothing, protective workwear, and top-brand personal protective equipment. What makes Ember stand out is the way it serves its customers. The company doesn't just sell safety gear. It customizes, embroiders, and delivers products directly to job sites through its brick-and-mortar retail stores, statewide e-commerce platform, and mobile service fleet. Ember serves industries where safety and compliance are critical, including oil and gas, utilities, construction, manufacturing, and the public sector. Oil and gas make up about 60% of revenue, but the company has expanded into other stable sectors like utilities and manufacturing to balance its client base. As shown on the map, Ember's operations span key regions across Texas, with 2 retail locations and a central headquarters that doubles as the main distribution hub. This layout supports efficient coverage and fast delivery to major industrial areas statewide. Some notable performance metrics include more than 70,000 registered e-commerce users, a 1-week average turnaround for custom orders, and consistent statewide delivery efficiency. Ember protective products are fire-resistant workwear, personal protective equipment like gloves and eyewear, and steel-toe footwear. Its strengths are an in-house embroidery, which supports safety and branding, and corporate uniform programs that make ordering and compliance easier for large clients. Lastly, Ember's mobile boot truck is a major value driver. It reaches job sites directly with more than 9,000 pairs of footwear available for fitting and safety demos. Altogether, Ember has become a trusted partner for industrial clients who rely on fast, compliant, and high-quality safety solutions. This slide highlights Ember's growth and evolution, focusing on the company's recent milestones. After being founded in the late 1970s as a provider of fire-resistant workwear and personal protective equipment, Ember's real expansion began in the 2010s, opening retail stores and moving into a larger headquarters that combined warehouse, embroidery, and admin operations for better efficiency. By the late 2010s, Ember launched its statewide e-commerce platform and mobile boot truck program, expanding accessibility and improving delivery speed across Texas. During 2020 and 2021, the company showed resilience by adapting to pandemic challenges and revamping its website to strengthen online sales. By 2022, Ember had diversified beyond oil and gas into utilities, construction, and public sector clients, creating a more balanced revenue base. And today, heading into 2025, Ember's continued growth is fueled by streamlined logistics, integrated operations, and strong management succession, positioning the company for long-term stability and scalability. This slide shows how Ember's management structure supports stability and long-term growth. Starting with the organizational chart, Ember operates under 2 officers, the CEO and president, who oversees 16 department managers responsible for accounting, sales, operations, IT, and logistics. Responsibilities are spread across teams, which means there's no key person risk. If one leader steps away, others can take over without disrupting operations. Ember employs 175 people, with both working in production and warehouse roles, providing strong operational capacity while keeping management lean and efficient. The Management Highlights section outlines 4 key strengths of Ember's leadership team: diversified leadership with clearly defined responsibilities, strong financial controls with no receivable issues and about $1.5 million in cash reserves, operational efficiency through low inventory write-offs, tight production management, and disciplined capital spending, and stable workforce with no hiring or retention challenges. Under forward-looking initiatives, management is leading a $1.2 million website revamp through 2026, staying disciplined with no major new investments since 2023 and maintaining a clean record with no litigation or employment issues. The government and risk overview further reinforces Ember's stability, with responsibilities spread across 16 managers, facilities leased at market rate, and no non-operating assets or major liabilities. Overall, Ember's management team is disciplined, financially strong, and built for continuity, positioning the company for sustainable growth.
Looking at the customer overview, Emmer's customers' relationships are built on reliability and fast service. Currently, 60% of its revenue is tied to oil and gas, with the remaining 40% from utilities and contractors. The company is actively diversifying beyond oil and gas by targeting industrial, construction, and public sector accounts. They're actively growing through their e-commerce platform, enabling scalable customer acquisition along with their mobile on-site locations across Texas. Customer loyalty is driven by their reliable inventory, fast in-house customization, and strong sales relationships. They have a 1-month inventory on hand for fast and quick turnarounds for their customers. Their historical performance has been really influenced by oil and gas cycles. As they expanded to utilities and industrial clients, they strengthened their price and their supply chain management, resulting in more stable and less cyclical business. Overall, Ember delivers high reliability with their service, with growing their customer diversity.
Okay, to touch upon a few key themes from our macro outlook, first we want to discuss some headwinds. Some headwinds going on in the industry right now is inflation. We extrapolated data in the producer price index showing price levels from 2024 compared to 2019, with price levels being up around 22 and 19% respectively. That's due to monetary policy and high inflation around this period, and the Federal Reserve trying to help the economy stay afloat. Another thing too is we have energy prices in the oil and gas market size to kind of give visual representation of what is going on in the particular industry, being that Ember serves these are the large concentration of Ember's clients. We wanted to use and show the forecast of those particular industries to show how much uniforms they would buy in as well. To touch on some tailwinds, you have the mandated regulatory compliance. So you have OSHA, who is driving minimum PPE requirements. So that gives companies such as Embar and others the opportunity to have visibility in what will be going on in their particular market as well.
We want to dive into the competitive landscape and positioning of Ember, where we are seeing industry growth being supported by strong safety regulations and emerging subscription models, while competition and cost inflation challenge profitability of the industry players. Looking at industry drivers, we see the high hazard market experiencing a rising amount of regulation and worker safety mandates, which results in a higher demand and ultimately market growth. The emergence of digital procurement, being able to showcase a business's products at the touch of a customer's fingertips, allows for selling efficiency and a broader reach. Then we are seeing a shift from the retail to the service side in the PP&E market, with an increasing amount of rental and lease contracts and a change in supply models. We then created a framework showcasing the estimated market size of Ember, in which we see out of the total addressable market of $47 billion, we believe Ember will capture $400 million in the coming years. Moving to the key risks in this market, there are existing contracts and customer concentration amongst the major names, and this magnifies the composition. We have also noted the cost inflation that decreases profit margins due to rising costs in materials, energy, and labor. Post-COVID, the pent-up demand has put a lot of pressure on suppliers that may now be experiencing a period of correction to adjust to the emerging market. To counteract these risks, we have highlighted some tailwinds and regional advantages for Ember, one being its location in Texas and its focus on serving within Texas. Texas is home to 5 major oil and gas formations and is also the U.S.'s top crude oil and natural gas producer, which ties into the expectation that extraction and fabrication industries are expected to have steady growth, and the U.S. natural gas market is being met with an increasing global demand, resulting in record high production. Now looking at the competition within the industry, the pyramid visual showcases the key names divided by national players, regional operators, and PP&E specialists. Now, an overview of Ember's direct competition. UniFirst is an expert in uniform and facility services with a reach from small businesses to over half of Fortune 500 companies. Cintas is a known North American market leader in uniform and facility services. Vestas provides uniform and workplace supplies, and MSA Safety is a global leader in developing, manufacturing, and supplying safety products, specializing in high hazard. To then paint the picture of market share between competition, we expect Ember to take on about 1% of the total market.
Diving into their financials, we are going to review the company's operating results over the past 5 years. From 2019 through 2023, the company's income statement show a clear pattern of contraction during the pandemic, which was followed by recovery and stabilization. Revenue increased from about $33 million in 2020 to approximately $58 in 2023, representing a pretty strong compound annual growth rate of 21%. Gross margins remained within 35 to 38%, suggesting consistent input costs and pricing. Operating expenses declined as a share of sales from 39% in 2020 to 29% in 2023. This indicates that fixed costs did not rise proportionally with revenue. Net income shifted from a loss position in 2019 to around $2.2 million in 2023, as higher volumes absorbed existing overhead. And for modeling purposes, we excluded non-reoccurring pandemic-related items such as PPP loan forgiveness and employee retention credits to present a normalized earnings base. Next, we'll review how these operating results translated into the company's financial position over the same period. Between 2020 and 2023, total assets rose from roughly $11.6 million to $20.4 million. The increase was driven by higher receivables and inventory, which both aligned with greater sales activity. Cash balances expanded. This reflected retained earnings and limited capital outflows. Fixed assets remained steady, indicating that growth was supported primarily through working capital rather than new long-term investment. On the liability side, accounts payable increased in proportion to purchasing, while long-term debt declined, and total equity grew from around $7.6 million to $13.6 million, fully attributable to retained earnings. Overall, the balance sheet data indicates that expansion during this period was financed internally with minimal leverage. With the historical performance established, this next section outlines the base case projections used in our valuation model. The base case forecast is grounded in data available before March 1st of 2024. This included the U.S. Census Monthly Retail Trade Report and analyses from BigCommerce, Retail Touchpoints, and Digital Commerce 360. All these sources pointed to moderate, steady growth in retail and e-commerce following the post-pandemic rebound. Management projected fiscal year 2024 revenue of about $63 million, while our base case actually produces around $62.2 million. This is a slightly more conservative view. Historical revenue grew roughly 21% annually, but we assume that pace is not sustainable given the company's niche focus and the rebound effects of COVID. The forecast here applies revenue growth of 6.9% in 2024, eventually tapering to 4.5% by 2029, consistent with broader industry expectations. Cost of goods sold was derived from the company's 5-year historical average and held within 63.5 to 63% range of revenue. A slight taper was applied to reflect modest efficiency gains while maintaining consistency with historical margins. SG&A expenses were based on the post-COVID 3-year average of roughly 30% of revenue, allocated between selling, administrative, and salary categories in line with recent trends. Depreciation and amortization were projected according to the company's maintenance level capital expenditure schedule, and interest expense was modeled at approximately 2% of EBIT, consistent with the 5-year historical average. Under these inputs, EBIT margins increased from around 3.7% in 2023 to just under 5% by 2029, with EBITDA margins around 5% as well. No changes to capital structure or tax rates are assumed. The effective tax rate remains near 12%. All of those income statement assumptions flow directly into the projected balance sheet, which outlines the company's future financial position. Projected total assets rise from $20.4 million in 2023 to approximately $38 million by 2029. Current assets such as cash, receivables, and inventory, of course, grow in proportion to sales. Cash specifically increases through retained earnings as no dividends or new equity is projected. Working capital metrics remain constant as a 5-year historical average of days, that is 54 days sales outstanding, 66 inventory days, and 53 accounts payable days. Fixed assets stay near $1.7 million, with depreciation roughly offsetting capital spending each year, and long-term debt declines through scheduled payments, leaving minimal borrowings at the end of the forecast. Lastly, equity increases from $13.6 to $29 million, which is consistent with accumulated profits. In summary, the forecast shows gradual asset growth, stable liquidity, and reliance on internally generated capital rather than external financing. Together, the historical results and projections provide a straightforward view of the company's financial position and operating outlook. That is, steady growth, stable margins, and no material change to leverage or funding structure. These figures form the basis for our valuation assessment.
For our cost of capital, we use a pure play method, weighing the competitors' betas off of the percentage of their business that contributes to the industrial workwear and PPE sector. After relevering the proxy, we arrived at a beta of 1. For our cost of debt, we use BBB yield to maturities for niche clothing retail companies, which is around 7%. For our cost of equity, our risk-free rate was the 10-year Treasury as of March 1st, 2024, yielding 4.19%. And our equity risk premium is based off of large cap retail companies' historical returns against the risk-free rate, according to Oswath Damodaran. Because of the microcap nature of Ember, we decided to add a 2% size premium to our cost of equity, which arrived at 11.7%. For weighing equity and debt, we use the company's current capital structure, which is 99-1, and it is relatively consistent among peers, with them all having over 90% equity. This therefore gave us a weighted average cost of capital of 11.7%. For our discounted cash flow, we use both the perpetuity growth approach and the multiples approach. For perpetuity, we assumed a 2% long-term growth rate consistent with US GDP and Ember's stable, mature operating profile. This gave us a range for 51% of equity value between approximately 9.8 million and 14.8 million. For multiples, we applied a 7 times EV to adjusted EBITDA multiple. This multiple was selected based on public comparables and precedent transactions, but adjusted slightly downward to account for inflated valuations observed in strategic acquisitions over the past several years. Using this method, we arrive at a valuation range between roughly 9.5 and 12.7 million. Moving on to the sensitivity analysis, the top table shows how changes in the perpetuity growth rate impact valuation. As the growth assumptions increase from 1 to 3%, we see the valuation rise from around 9.8 to 14.8, indicating that long-term growth has a more pronounced effect than modest WACC adjustments. The bottom table reflects EBITDA multiple sensitivity, where a change from 6 times to 8 times moves the valuation from 9.5 up to about 12.7, further reinforcing the importance of terminal assumptions, which are based off of the high growth of the industry, our confidence in their e-commerce expansion, and management's focus on long-term sustainability. To summarize, our base case uses a 2% perpetuity growth rate and a 7 times terminal multiple, producing a valuation range for 51% of equity between 9.5 million and 14.8 million. We decided to build an LBO model to estimate what a private equity sponsor would realistically pay for Ember based on their activity in the lower middle market space. The transaction assumes a total purchase price of about $22.4 million for the full company. That's funded with 49% debt and 51% equity, reflecting typical middle market leverage deals between 2.9 and 3.1 times EBITDA seen over the past year. On the return side, the model assumes a 6 times entry multiple and a 7 times exit multiple consistent with what we use in the DCF. With those assumptions, we used 11.7 for our sponsor required IRR, which is also consistent with our WACC that we used for the DCF. At that valuation, 51% of equity would be worth around 11 to 11.8 million, slightly below the DCF midpoint, but within the same range. Overall, this LBO implies that a financial buyer would justify paying roughly 22 million for 100% of Ember, driven by moderate leverage, conservative entry multiples, and stable cash flow performance.
Okay, so to touch on our comparison models, for Ember, we built out the public comparison model and the precedent transaction models. To first touch on our public comparison model, it makes up around 10% of our overall valuation. We chose 4 market participants such as MSA Safety, UniFirst, Vestis, and Cintas. We believe our closest comparable was UniFirst, and we segmented our business in 3 segments: industrials, business, environmental services, and uniform and textile rentals. All of these companies have large portions of their revenue coming from uniform rentals or some form of personal protective equipment. And we feel there were great comparisons to Ember going on in the public markets. Our chosen multiple was enterprise value to adjusted EBITDA, as we feel it's a great reflection of what's going on from an operationally sound business and comparing that to the total summation value of the company. The overall range we had for our public comparables was around 10.7 to 17.5 times, with a final range being from 9.6 to 12.4 times. If you look to the graph under multiples growth, this is for precedence, but I feel it's a great representation of what we've seen going on in the public markets as well. If you go all the way back to August 2016, multiples were around 14 to 16 times from an enterprise value to EBITDA, and then around a 0.5 to 1.5 time multiple for EV to revenue around that time. We have a kind of slight dip in 2017 and 2018, and then you kind of have a recovery period, and then you have that slow period, which is where COVID lies. And we believe that's because, everyone was at home. There was a contraction within the market, meaning that most people weren't outside utilizing the energy price, using that energy and causing contraction because there wasn't a necessary capex spend need for companies to invest and buy uniforms. And coming out of COVID, we kind of seen an uptick both in the private markets while also being in the public markets as well, as companies such as MSA Safety has posted like their record-breaking revenue numbers and their stock price hitting all-time highs as of the date of this valuation, being reflective of these high multiples, why we have such low weightings towards our public comparables, and why in precedence we have a 5% weighting in Merit. One thing I also want to highlight, majority of our precedents do or are more large-scale companies. There's a lot of consolidation in the industry at that kind of lower middle market or micro business level, and where you're seeing constant acquisitions, but there isn't a lot of data to present or display in this style of presentation. But I did want to make note of some key acquisition or key companies who were making acquisitions. You have Brookfield, who's a large alternative asset manager who's looking to enter into the uniform and rental space. You have MRAC bought by, buying a Mary Pride, integrating that, and then you have VF Corporation and Superior Uniform Group. Also, I want to say the closest precedent transaction that we've seen in the market was Clean Uniform, who was actually bought by UniFirst for 33 times enterprise value to EBITDA multiple. And I think it's just reflective at this time of how the market really sees these companies and believing in that growth and seeing that pent up demand and seeing these companies have that kind of margin, that multiple expansion, things of that nature as well.
Integrating the results from these 5 different valuation methods, we conclude that a 51% equity stake in Ember is valued at approximately $12 million, implying a total enterprise value between $22 and $24 million. Greater emphasis is placed on the DCF and LBO outputs, as both rely on intrinsic performance and realistic capital structures rather than external market volatility. Less reliance is placed on market-based valuations, since comparable transactions completed before and during the post-COVID period often reflected inflated multiples driven by temporary demand surges and low interest rates. Those conditions have normalized, making market data less reliable for this case. The final valuation reflects a disciplined midpoint that incorporates industry growth prospects, strong management execution, and steady long-term performance expectations for a company of Ember's profile.
Thank you so much for the opportunity to participate in this competition.
The remainder of the presentation will be the appendix, where we have our sources and the models we use for our case.